Good morning. It's great to be with you again. Can you believe the year is nearly over? It's our final webinar for the year, and the holidays are almost upon us. And that brings us to our little cute meerkats here who are clearly waiting for their Temu order to arrive. Anyway, November was a decent month for markets, and it's wrapped up an amazing year in terms of returns. But volatility is definitely back. We saw some big pullbacks in November before things recovered. And I think it's going to get a lot more wobbly from here. So stay tuned for our outlook for 2026 and some interesting views on the Transnational Fund and the Sygnia Dollar Plus Fund. Let's have a look at markets. So this is the returns in rands for 2025 year to date. So that's to yesterday. And you can see some pretty decent returns across the asset classes. Gold being the outstanding performer, nearly 50% return from gold, which is definitely not bad for a risk-free asset. Bitcoin being the digital gold, not doing quite as well, down 8% so far this year, and a bit more volatile today, in fact. But generally, if you look at the chart, everything up quite nicely. SA equities and SA bonds in second and third place. SA equities up 37% in rands. SA bonds up 21%. China kind of coming in next, so definitely an EM story. And the rand very strong. US dollar cash minus 9%, which means the rand strengthened 9% over the year. So some fantastic returns for South Africa. If you weren't in gold, the place to be was South Africa. And part of that was obviously linked with 36% of our top 40 being linked to precious metals, either PGMs or gold. But EU doing nicely, China doing nicely, emerging markets doing nicely. The places you didn't want to be was, besides Bitcoin, was global bonds. That's down 3% in rands. And global property, only up 1% in rands. But everything else doing pretty nicely. So not a bad year in terms of market returns. How's that impacted the funds? Well, if you look at the bottom table, which is the 12-month rank, so this is 12 months to 27th of November, so slightly different to my last slide. You can see it's still an all emerging market story. Emerging market 50 there in the third place. South African top 40 in first and second, thanks to the great performance from the gold stocks and the platinum stocks. iTrix top 40 at 39%, the top 40 unit trust at 38.6%. The Transnational Fund coming in at fourth place. And I'm going to be talking more about that later. It's a great way to diversify your portfolio because the all share itself has become quite skewed in terms of its very large exposure to gold and to banks. But more about that later. And then property coming in at fifth place. So, it's a property. Now, moving on to the 1 month, you can see there property was first for the month and bonds were fifth for the month. And that was after the very, very, very strong and pretty excellent medium-term budget policy statement. And that saw the rand strengthen, our bond yields fall, and bond prices rise, and the property sector also rose. And I'll talk more about the medium-term budget policy statement as well in the SA sector. Coming in at second and third place, we have the Sygnia Health Innovation Fund, a fantastic return of 7.6%. That's on the back of a great return at the end of last month. So well done to any of you who bought healthcare after the last webinar, when I said that many of the conditions had been met to buy. The only condition that we're still waiting for, and it hasn't ticked, is earnings revisions. So earnings revisions are still negative. Part of that was Novo Nordisk, which in the month actually reached a new 5-year low. Things not looking very good there for that weight loss company. But despite that, healthcare doing very nicely overall. And then fourth place for the month, a nice bounce from the Sygnia Life Berkshire Hathaway Fund. We had Warren Buffett's final, it's very, very sad, but his final letter to shareholders as he went silent, as he calls it. It was another great letter. All his letters are fantastic. And then a week later, there was the holdings announcements just showing that Berkshire Hathaway has continued to sell down Apple, but they've made a new purchase of Google, bought about $4 billion worth of Google. Still much smaller than the Apple stake, but switching out of Apple into Google. And the market is pretty much like that. And that's why a decent return out of Berkshire Hathaway for the month in rands, even with the stronger dollar. So some great returns for the month and some great returns for the year. Another great year in 2025.
So with my signature, the federal government will now resume normal operations and My administration and our partners in Congress will continue our work to lower the cost of living, restore public safety, grow our economy, and make America affordable again.
Trump obviously broken the teleprompter again, so reading off script. But interesting that he's talking about make America affordable again. No longer are we talking about make America great anymore. It's about making America affordable. And I think that's very important because we know what the biggest thing that killed Biden in the elections was the inflation, the COVID level inflation that was still persistent, and people feel inflation very, very strongly, particularly cumulative inflation, even though we happen to look at a year-on-year number. So right now, Trump is getting lucky because the US government was shut down. And as a result, there's no inflation numbers until mid-December. So that's a delaying of the October number and the November number. So if there is inflation, you can't see it, and what you can't see doesn't exist. So, Trump getting lucky. However, Trump did, as we saw here, sign a funding bill into law, which ended the longest US government shutdown on record. However, the law didn't see a renewal of the subsidies for the Affordable Care Act. So that could lead to a further impasse and deadlock at the 30th of January deadline when this temporary funding bill ends. But for now, the government shutdown is over, and that should help with the dollar and US growth. Why? Well, because once the shutdown is over, you've got resumption of public spending, so they've got to catch up on that spending, and you've got all the back pay to everyone who was furloughed during that period, and that gives a nice bounce to economic activity, and that drives the dollar stronger. And you can see on the chart on the right here, looking at the 2018-2019 shutdown, the 2013 shutdown, and the 95-96 shutdown, the dollar strengthened at the end of all of those shutdowns. So we should see some dollar strength this over the next month or so. However, it all depends on what's going to happen at the Fed. And it was actually absolutely fascinating to watch the Fed this month. I mean, we were riveted to this one chart, which just showed the probability of the Fed cutting rates in December. So they've cut twice so far this year, and the question is, will they cut in December? Now, the October FOMC minutes came out, and they were quite hawkish. In fact, most voting members said they didn't want to cut in December. And the probability of a cut in December fell from about 80% down to 24%. And as a result, the market fell accordingly. In fact, the NASDAQ fell 8% before it recovered. There were some issues around technology stocks, which I'll talk about later, but a lot of it was this concern that the Fed was removing the punch bowl, the party was over, and money was no longer getting cheaper and cheaper as the Fed continued to cut rates more and more. But the market was saved because after that, after the minutes came out and the market fell, we had a few FOMC members coming out, and they made some very dovish statements saying that they supported a December rate cut. And the probability of a December rate cut rose from 24 back up to 80, and the markets rose as well, almost back to the same levels they were, still slightly lower. But that was the volatility that we saw during the month. Fascinating to see how you get such huge amounts of volatility, 8% fall in the biggest stocks in the US market all around this Fed rate cut. Now, what should the Fed be doing? Should the Fed be ending the rally? Because markets just don't die of old age. They only ever die when there are rate hikes. So let's look at the data. Let's look at the facts. The US economic growth is accelerating into the year end. If you look at October PMIs, and I'll show that in our Outlook slide, you can see growth is accelerating in the US. In fact, it's accelerating around the world. US Q3 company results were fantastic. Not only were they much higher than expected, but they were much broader. It wasn't just the Magnificent Seven that was driving returns, but the whole economy seems to be doing well. Inflation is also still pretty strong. It's sitting around 3%, which is a percent higher than the 2% Fed target. And we still have the risks that tariff and immigration policies could push inflation higher in the first quarter of 2026. So looking at growth, the Fed should stop cutting rates. Looking at inflation, the Fed should stop cutting rates, which means that we could have an end to the party. But at the same time, the employment numbers continue to look weak. Not recessionary levels weak, but they are weak. And it's weak enough that it allowed the Fed to cut twice so far, and possibly it will allow the Fed to cut in December if there is political pressure. And I think that's what's key, because we've now had Trump announce his replacement. He hasn't said who the replacement is. He's just said that he has chosen a replacement. The market thinks it's possibly Kevin Hassett, who is quite dovish. So we could see, I mean, we're only talking now, I mean, Powell's here until May next year. So Powell's last FOMC meeting is April. So this is not happening anytime soon, but it's all about the anticipation. Because if the markets are anticipating a more dovish Fed chair to come in, well, then they can start pricing in more cuts. And that means that the Fed put is there and markets can be supported and the rally will continue to go and the dollar will continue to fall. And it's great for emerging markets. But it also means we're kicking the can down the road and inflation could actually get a lot worse down the line. So it's all about, what is going to happen. If you were just looking at the hard data, the Fed shouldn't be cutting right now. And we could expect a huge pullback in the markets next week when the Fed doesn't cut. However, the markets are pricing in a big cut, and it's likely that they will because there's some political pressure and employment allows them to do it. And they possibly don't want to upset the market. So we'll be watching it very closely to see what happens. It's really hard to tell, but for now, the market is pricing in an 80% chance of a cut. And so we are remaining overweight equities. But at the same time, we're also overweight emerging markets because that does lead to a weaker dollar.
Been a lot of talk about an AI bubble. From our vantage point, we see something very different. NVIDIA is unlike any other accelerator. We excel at every phase of AI.
So it's amazing how markets can focus on one or two things at a time. They really have a very, very focused attention span. One was the Fed, and the other was NVIDIA's results, because NVIDIA is the biggest company in the world, and it's the most forward-leading in terms of the AI spend. Everyone who's all these hyperscalers who are trying to win the AI race, they all need NVIDIA chips, and now possibly Google chips. And so we did see a bit of an NVIDIA pullback because of Google rallied, but everyone was waiting to see what the NVIDIA results were doing. And the results were much better than expected. And not only were they better than expected, but for the first time, NVIDIA gave quite a decent 15-month forward-looking projection on their order book, and it looks like there are some strong orders. So you'd think that the market would rally, but despite this, the market pulled back a lot. NASDAQ in particular pulled back, as I said, 8% in December. Now, a lot of it was the Fed, as I mentioned, but there are some reasons to also worry specifically about these Magnificent Seven stocks and hyperscalers in particular, and NVIDIA as well. So the first thing is debt. The hyperscaler bond yields climbed to their highest level. It's the spread above the government bond, climbs to the highest level since the start of the year, which means that bond prices fell. And that just reflects that investors are worried about the huge amounts of debt that these hyperscalers, Microsoft, Meta, Google, all of them that have to take on these huge amounts of debt to finance AI investment. And it looks like about $400 billion is going to be spent this year alone on AI capex, and with very, very strong numbers over the next 2 to 3 years as well. Now, so firstly, that's a debt concern, and we're seeing that debt prices bond prices are falling, and those yields are rising as they're pricing in a higher risk premium. Then the market's worried about depreciation, because in 2020, the hyperscalers, again, Microsoft and Google and Apple and Meta and all the rest, they began extending the depreciable life of their servers, basically their chips, from 3 years to 6 years. Now that has a huge impact. For example, Meta, in January this year, they adopted a 5.5-year useful life for their servers from a 3-year number, and that added $2 billion to the 9-month results to September. So you can just imagine that huge windfall that all these hyperscalers have seen over the last 5 years as they've extended the depreciation charge from not 1/3 each year to 1/5 or 1/6 each year. But that's now going to catch up to them by next year. and they're now spending huge amounts. So they could see by 2027, these hyperscalers could see $240 billion in depreciation charges, which will hit their margins significantly. Now, it's not just that's worrying markets in terms of margins, but investors are worried about how these AI companies and hyperscalers, not so much Nvidia because they sell chips, but how the users of AI, OpenAI and Grok and Gemini and all the rest, how they're going to monetize that. Now, certainly they are monetizing quite well, but they've got a long, long way to go. In fact, JP Morgan estimates that just to achieve a 10% ROI, and that's much lower than the ROI that these companies have been getting historically, that have been around 30, 40%. Just to get a 10% ROI would require additional annual revenue of these hyperscalers of $650 billion a year. That's huge. That's 0.58% of global GDP. It's a massive number. And as a result, investors are a bit concerned about all of these things, and earnings revisions for the Magnificent Seven have started to be revised downwards. And the 3-month earnings revision numbers are negative, actually, in these companies. Now, so there's reasons to be concerned. Not, it's not the end of the party, but everyone's starting to maybe price a bit more realistic valuations into these stocks and say, listen, it's not a given that they're going to continue growing at their current rates that they have. In fact, it's looking nearly more attractive to start rotating out of Mag 7 into the rest of the US. So the S&P 493, which is the S&P 500 less the Mag 7. You can see the charts on the right here. The light blue is the Mag 7 earnings, and you can see 2023, 2024, those earnings growth numbers were around 50%, and the rest of the US market was growing at 0. So clearly the only place to be was the Magnificent Seven. But we've now got to the point where the S&P 493 has had their best earnings in 3 years. And that gap has narrowed significantly over the last 3 years to the narrowest it's been in 3 years. So a lot of investors are saying, well, the risks are rising, the valuations are pretty intense, so maybe we should rotate out of the Mag 7 into the 493. And that's also supported by the Fed cutting rates, which just the smaller companies rely on debt financing a bit more, and market funding as well. And so as the rate cuts come down, it supports the rest of the market more than the Mag 7, who have got so much cash, they don't actually quite like higher interest rates. So we'll be watching this very closely. Right now, we're still neutral, US. And within the US, we are neutral. So we don't have an overweight to the 493. We don't have an overweight to our FANG.AI fund. We're waiting to see how this plays out. But we could see some rotation out of FANG and into the 493, which, if you want to play this, the way to play it is by buying Berkshire Hathaway, which is the 5th biggest company on the US stock market and has a broad industrial portfolio and financial portfolio and consumer portfolio. It's only got a bit of Apple and Google from tech. So if you're looking at a way of playing this in terms of your Sygnia funds, you could sell out of your S&P 500 and switch into Berkshire Hathaway, and that you could rotate in that way. But we're not doing that just yet. We think that you're still waiting for a stronger turning point. But for those of you with long-term time horizons, maybe it's a good time to diversify. Now, I said we're still neutral the US, which we are. In fact, we're neutral US against Europe and Japan, and we're overweight emerging markets. But we are, despite all the excitement that happened around Europe at the start of the year, we're getting itchy about switching back into the US. Maybe the US 493, maybe Berkshire Hathaway, because the US is definitely being supported by AI. Productivity numbers are fantastic, and I'll show in another slide US earnings growth and US productivity against Europe. But from a longer term perspective, the US has the support from AI. So GDP growth over the long term is 2 things. It's how many workers you have. So it's the growth in labor supply and how productive those workers are. So, how many widgets each of those workers are making. And that productivity is directly linked to AI. The chart on the right here shows, this is from JP Morgan, they consolidated 5 different AI readiness scores. So they included Stanford, the IMF, the government AI readiness, IMD, World Digital Competitiveness, WIPO, patent stats, and put those all together to see which country was leading the AI race. And by a mile, it is definitely the US, which means the US is going to have the best productivity, which actually then means they're going to have the best growth and best earnings and best margin recoveries. So it looks like the US is could grow by 1% more than the rest of the world because of its strong AI growth. Now, China is behind that at about 1.5%. China doesn't translate directly as much as the US because China has a much bigger manufacturing sector. And AI is directly important for services, whereas manufacturing requires more robotics. And AI does help robotics. So I'm not saying it's not going to help, and it definitely will help China. They've got a very strong support, but probably not as much as the US is seeing. So maybe half of what the US is seeing. But if you look at this table, you can see the top 10 dominated by developed markets. And emerging markets are dominating the bottom 10, which is not great. In fact, if you look at South Africa, we are consistently worse across the entire range, coming in stone last. So this is just a snippet of that report. It just takes the top 10 and the bottom 10. There are about 40 countries in the report, and we are stone last, which ties up with a different report that came out this morning from Alpine Macro, which looked at the R&D score of various countries around the world, R&D spend relative to GDP. Who was second worst in the world? South Africa. So if you're not spending on R&D, you're not spending on AI, you don't have that productivity support that is so important, particularly in a low growth world with aging populations. So while we are tactically overweight emerging markets, strategically, based on this table, you want to be underweight emerging markets and you want to be overweight the US. But as I said, we haven't made those switches yet. So AI not only helps earnings growth and GDP growth, but it also moves pricing power from labor to capital, which leads to margin improvements, which is good for earnings, and it lowers inflation, which allows more rate cuts. So it just generally and that helps the valuations of stocks. So it helps your stock market not only from an earnings perspective, but also from a valuation perspective. Now, it's not unfortunately a free lunch. There's always a downside to new technologies, and that is definitely the impact on employment. New technologies in the short term can lead to significant job losses. Yes, new jobs are created in the long term, and we'll very likely see that as we've seen in all the technology shifts we've seen over the past. But in the short term, employment is already quite weak in the US. And if AI makes it worse, just as inflation starts to peak because of immigration and tariff policies, well, then the Fed's going to be in quite a hard spot. Unless, of course, Kevin Hassett says, damned inflation, don't worry about inflation, we're going to cut anyway. And then the debasement trade is going to be full on, and gold's going to go to $10,000 and Bitcoin to $1 million and all sorts of debasement trades. So we're watching that quite closely. I don't think it's going to be that blatant, but it could be, maybe 25 basis points more cuts than you need, and keeping the dollar a little bit softer than it should be, and keeping the bull market going a little bit longer than it should be. So we're watching this impact of AI on employment growth, and the Fed is key to everything, as I have been saying. Now, the other reason that could keep the dollar stronger, at least against developed markets, not emerging markets, is that the euro has significant headwinds. At the start of the year, it was all about Europe and the huge amounts of money that Germany was going to spend on infrastructure and how that was going to revive Europe, and the huge defense bills as these European countries go from 1% of GDP spent on defense up to nearly 5% of GDP over the next decade. And all that money we're hoping is going to support Europe. It didn't this year. I'll show you on next chart. But not only that, but we saw France have its credit rating downgraded because of budget deficits, structural budget deficits due to excess social welfare and pension spending. It sounds very, very similar to a country I know not very far from me. I'll talk more about that in the South African slide. But excess social welfare and excess pension spending seeing France being downgraded. And France has had 5 prime ministers in the last 2 years. It's just amazing. And despite that, their 2026 budget still lacks the ability to reduce deficits. And political fragmentation is keeping the government from making any serious reforms. Now, we don't see huge contagion risk to the rest of the EU, but it is likely to be another reason that the euro doesn't strengthen. That, and Germany continues to face headwinds to its growth because it's losing market share to China. China having to find new markets because the US is shutting them out, and certainly making inroads into Europe, stealing market share from Germany, and definitely, as I'm sure many of you have seen in South Africa, the number of new Chinese cars that are on our road, and pretty good-looking cars, I might add. I mean, I can't even keep up with, I don't even recognize the brands, but there's a lot of new cars, and we're seeing VW and BMW losing market share to China. And those companies having to even cut their prices into the US to the point where they might actually completely withdraw from the US. They're just not making money anymore. So there's still some big headwinds to Europe. Political fragmentation, and they're far more reliant on exports in China. I think I showed that last month. China's exports only make up 20% of its GDP, whereas Europe is nearly half of its GDP. And as China steals that market share, Europe is going to continue to struggle. But let's look at the chart on the right, which is fascinating. It shows year to date, the blue bars. That is the PMIs. So that's the US PMI, and the PMI is just an index which shows the proxy for growth, GDP growth, and that's US PMI minus European PMI, and you can see they're nicely positive for the US over the last year, 2 years, and that's despite the tariffs. And look at the earnings growth, the bar on the most right-hand side, which is S&P 500 EPS growth minus the Stoxx 600 EPS growth. That's the earnings growth over the last quarter. So Q3 of 2025, 14% differential. That's because US earnings grew around 11% and EU earnings fell 3%. So we're definitely not seeing anything to get excited about right now in terms of Europe. Maybe we'll see some recovery in the EU earnings next year, but we still have the headwinds of political headwinds and German growth headwinds that could slow those down. Now, one of the things that could be an outlier is a peace dividend, and possibly Russia and Ukraine could come to some sort of agreement to end the war, but it's unlikely to be a huge dividend because even if peace arrives, sanctions aren't going to stop. And the EU has committed to completely moving its energy, its natural gas purchases away from Russia by the end of next year to the US and other countries. So those costs of energy aren't going to suddenly disappear as those sanctions will stay in place. So there might be some support to the EU in terms of rebuilding the Ukraine and the defense spend and Germany's infrastructure. But when it comes down to growth, it's all about productivity. And it's all about unit labor costs and the structure of your labor market and labor unions. And Europe just can't compete with the US, just like South Africa can't compete with many, many countries.
We urge the Japanese side to behave itself. Taiwan is China's Taiwan. It is an inalienable part of China's territory. No amount of posturing by the Lai Ching-te administration can alter this immutable fact.
So as I said last month, Japan has their first female prime minister, and she came out early this month basically attacking China, saying that if China were to physically invade Taiwan, it could see a military response from Japan. And that has got China's feathers ruffled hugely, and they're threatening sanctions, and they've stopped remove fishing rights and exports and all sorts of reprisals in the short term. Now, that definitely complicates things between Trump and Xi Jinping because the US has obviously got very good relations with Japan. So we'll be watching this quite closely. I'm not forecasting any sort of invasion of Taiwan by China or any increase in the political risk premium, but it does make noise and always leads to volatility, and it could complicate overall relationships in terms of the geopolitics. So we will be watching this quite closely. But generally, we do continue to like China and emerging markets, China being a big part of emerging markets. Chart on the right here is just another reason why we continue to like China. It was just 2 years ago, 2022, 2023, there you can see China in the dark blue. Their perception of investability was close to 20%. And the US was about 65%. So the US was hugely favorable and China was seen as uninvestable. Now, over the last 2 years, look how that's reversed. Trump's policies, at least his uncertainty about his policies and the way he whipsaws between different views, has made the US almost uninvestable. That's fallen from 65 down to 35, and China's nearly caught it up, rising to just below 35%. And that's important because it allows China to attract foreign investment, fixed investment and short-term capital flows, but it also allows China to sell its products to a wider market. So that's very important, and you can see there how we're almost leading to a point where the rest of the world is saying, well, we can't get on with the US. We can't afford to sell into the US. We're not allowed to sell into the US. So let's work with China. And you've got this huge swing away to the southern bloc. Now, it's not just external investors that are getting more excited about China. Chinese domestic investors are also investing more in their stock market. But household bank deposits are still well above historical averages, and interest rates are at historic lows. So we could see further rotation of Chinese investors as they switch money from their bank accounts, which are earning nothing, into the stock market, which is giving very nice returns over the last year. Other indicators why we like China, M1 money supply has accelerated in recent months, and that typically leads Chinese growth. So it's a nice forward-looking indicator. There's also continued policy support that comes out from the Chinese government, and that should continue to support growth and domestic consumption. So we remain overweight emerging markets, and we do continue to like China.
South Africans. We convene at a time when South Africa, like many nations around the world, is grappling with intensifying global competition and mounting economic and political divisions.
So we had a fantastic medium-term budget policy statement. And not only that, but a few days later, we saw the S&P upgrade our credit rating. And there's now even a possibility that Moody's will change our outlook. And certainly there's been a very positive reception from foreigners. We've seen foreign buyers come back in droves into the SA bond market. Not so much SA equities, but definitely back into the SA bond market. However, we have downgraded SA bonds to neutral. We remain tactically overweight SA equities, but we might downgrade that to neutral at some point as well. But for now, at least on the equity side, we're waiting for foreigners to push the market a little bit higher. Maybe gold and platinum prices will push it a little bit higher. But I think that although the medium-term budget policy statement was awesome, unfortunately, even though we've got an amazing treasury team, an amazing finance minister, the finance minister and his team cannot get growth to recover on their own. I mean, they're doing everything they can, but you can't have one cog in the entire government running or supporting growth and getting growth to recover. So let me take you through this table. Now, we had a fantastic budget statement. A lot of foreigners are upgrading in South Africa, and there's a lot of forecasts for either a V or a U-shaped recovery. So I agree with all the forecasters. I think that our growth has troughed. I think we've seen the worst. But I'm leaning more towards an L-shaped recovery. That is basically, yes, things aren't going to get any worse, but they're not going to get any better, at least not in the next year or two. Maybe longer than that, we could see private-public partnerships start to see some growth recovery. But in the short term, I'm not so bullish. So why am I not bullish? Well, let me take you through this. So I've got two tables here, a reason to be bullish, a reason to be bearish, and different indicators. So the first one is global macro. And the reason we've had such amazing stock market moves in SA and inflation falling and the strong rand has all been because of terms of trade improvement. It's because gold and platinum and iron ore and coal have all done very nicely, whereas oil has fallen. So that means we're exporting, we're getting more money for our exports, we're getting less, we're paying less for our imports. and makes us relatively more wealthy than we were before. And that allows our currency to strengthen, which lowers our inflation, which means we're going to have rate cuts, which means our companies can get more money. And it's just a great positive cycle to be on. But it's in spite of South Africa. It's got nothing to do with us. It's just the global macro story. And even though it has been very good for us because of our low growth and our productivity issues, we definitely haven't participated in this party as much as we should have. We haven't been able to mine as much as we should have. We haven't been able to export as much as we should have because of various SOE backlogs. So let's talk about the SOEs. Now, there are reasons to be bullish. National Treasury is doing a great job monitoring SOEs in general, and they're not handing out money unless they're seeing some sort of improvements, and they've got various checklists before they hand out new checks. They've got a new procurement dashboard, which is great. They're also sorting out Eskom's distribution agency agreements, which means that going forward, whereas currently municipalities aren't paying Eskom, they're defaulting on their money to Eskom. Eskom can now contract directly with the underlying consumer, and they can get paid by those consumers or turn off that consumer's power. So it will help Eskom to some extent recover more money than they should. Of course, it's going to mean no money going to the municipality, which means municipalities might default faster than they were before. But at least we're trying to fix SOEs, even if it doesn't help the municipalities. That said, we looked at investing in Transnet recently in some government guaranteed paper, which, by the way, we didn't get any because we had global investors, PIMCO, in fact, come in and buy the whole lot way under market. So the foreigners are back. But if it wasn't for the government guarantee, there's no way we would have touched Transnet paper. They are way behind on their public-private partnerships. They've got a list of 12 that they want to do, and only one has the tender actually been accepted. And that's been going on for a while now. Not only that, there's still major security concerns. They've only sorted out 68% of the security concerns. They've got huge covenant breaches on their debt side, and they've seen credit downgrades. So, yes, National Treasury is doing a great job of keeping an eye on things, and things are improving, but it's a very slow turnaround for these SOEs. They're huge ships, and they're going to take time to steer in the right direction. We'll get there, but not in the next year. And we're only going to see private rail line come onto the tracks probably the end of 2027 or 2026. So, that means that you can't start forecasting that growth number anytime soon. So let's talk about growth. On the positive side, National Treasury have also rolled out the Infrastructure Finance and Implementation Support Agency, which is designed to fast track public-private partnerships, which is great. They've also amended the municipal PPP regulations to fast track private-public partnerships. And as I said, the only way growth is going to improve going forward is if you've got the private sector keeping an eye on government spend and government projects to make sure that they happen on time, on budget, without corruption. Unlike what happened to Medupi and Kusile, which were 20 years late at 10 times the price. So the PPPs should, in general, help turn our growth around. And I am positive they will. I just don't think it'll be U or V-shaped. I think it's going to be a very long L. Why? Well, the chart on the right is why. Yes, we had a great medium-term budget policy statement. And yes, the National Treasury promised that our debt to GDP will peak this year. Now, it actually got worse this year, and it was been worse than expected every year since 2008. So we've got quite a consistent, nearly 20-year track record of being worse than expected. One of the ways they are going to achieve that peak is by raising taxes. Now, we already are at the end of the Laffer curve, where we can't actually put taxes any higher on any sector of the South African economy. But you can see there in the green, the budget of 2025, they're already forecasting higher tax to GDP ratio, and they've put that even higher on the black line. And high taxes is never good for growth. It's never good for productivity, as people just don't invest. I'd rather invest offshore where there's lower taxes. Now, yes, to some extent, they've said this, and this is not not going to affect you or I or current taxpayers, but they're trying to target people who have been avoiding tax. But irrespective, it's money that would have otherwise been spent. It's now going to be taxed, and things are going to get tighter all around. Now, not only that, but again, fantastic Treasury doing the right things, and you've got other parts of the government which are rolling out the business licensing bill. Now, this is a huge red flag. Everyone has come out to say this is an absolute disaster for South Africa. It's going to increase bureaucracy. It's going to increase red tape. It's going to increase the potential for corruption. It's going to stop new businesses from being formed. It might even lead to existing businesses shutting down. So how on earth are you going to grow the country if all your small, medium enterprises now face this extra red tape and either are forced to shut down because their license isn't accepted, or that they don't even bother to start because of this new license? Plus, we do have other issues like NHI, which hasn't gone away, and other differences in ideology. And that brings me to the next point, politics. Yes, the GNU is great, and we avoided being a failed state. But that doesn't mean that the GNU is going to lead to V-shaped recovery. Why do I say that? Well, South Africa's still got 30% tariffs, which again is not good for our growth and it's not good for our employment. Now, why? I mean, the rest of Africa, every other country in Africa has seen their tariffs being cut, but not South Africa. We also look like we're going to be kicked out of AGOA. Not only that, but we've been excluded from the G20 next year by the US. Now, I'm not saying that's Cyril's fault. I think Cyril has done a fantastic job, but it does. The point is, we're the only country that's been kicked out of G20. We're the only country that's been kicked out of AGOA. We're the only country that hasn't seen the tariffs being cut. So clearly, we're not embracing or trying to work with the rest of the world, and we need to. We're desperate for investment. We're desperate for growth. We're desperate to create employment, and we need all of the world we need to work with the rest of the world. So we need to get over our ideological barriers and try and become more market focused. So until that changes, I also think that's a hurdle to growth and to a V-shaped recovery. Now let's talk about inflation. Now, one of the reasons why bonds have rallied so strongly and foreigners are getting back into the bond market is the lower inflation band, which has been lowered from 3 to 6, so it's a midpoint of 4.5, down to 3, with a midpoint. 3 is the midpoint, 2 to 4 with a 1% band. That's a huge improvement. Now, yes, it does bring us in line with other emerging markets, so it's not unrealistic, but it is unrealistic if you look at the administered price inflation we likely to see over the next 3 years. That's sitting at about 7%. That's Eskom and NERSA and water prices and your municipal bills, rates and taxes all going up about 7%, which means the rest of the basket has to go up 2.5%. Now, that excludes the government wage bill, which is forecast to grow at 4.1%. Now, I think 4.1% is wildly optimistic. We've never actually come in at our target before, but even if we do, it's still higher than 3. That means the rest of the basket is going to only grow at 2%. Now, that is going to be very, very difficult to achieve. So I think we're going to struggle to get down to these inflation numbers. And so it's why we do actually prefer in our income funds, we've been buying a bit of inflation-linked bonds. We think that that's looking a bit more attractive than nominal bonds right now because inflation is likely to surprise to the upside. Now, just throwing some things into the other category, positive. Yes, we were removed from the FATF grey list, which is great. That should help growth. But as I mentioned, we've got the lowest global AI readiness score, and we've got the second lowest R&D as a percentage of GDP globally. So we certainly aren't embracing productivity improvements in South Africa. And my final point is just on the credit outlook. Yes, we were upgraded by S&P, and Moody's might improve us, but that's only from BB minus to BB. To get to investment grade, you've still got to go to W plus, and then once again to BBB minus. So 2 notches are required to get us to investment grade. Now, I can't see us getting there because the average emerging market investment grade country has a debt to GDP of about 40 to 50%. Ours, even in the wildly optimistic forecasts by National Treasury, is sitting at 67% in 2033. So we're nowhere near to that. And the acceptable levels of sustainable debt for emerging markets are 60%. So even higher than a sustainable level, let alone investment grade level. So why do I say debt's unlikely to come down even to what the National Treasury is forecasting? Well, because most importantly, I think growth is not going to recover as fast as everyone's hoping. Yes, terms of trade are going to stay positive for a while, and our growth might improve from 1% to 1.5%, but I don't think we're going to get close to 3%. Not only that, but our debt to GDP has got some hurdles. I mentioned wage inflation, which is probably going to be higher than expected. The debt service cost assumptions are also wildly optimistic. They're forecasting that we're going to be raising new debt at 7%, which means that the whole bond curve is to fall by 4%, which is very unlikely. Our CDS spread is nearly the same level as some European investment grade companies. So there's not much more room for compression. That and the COVID grant, which is about 30 billion rand a year, that is only forecast or included in the budget till March 2027. So for one more year. So what happens to that? Because I can't see that being removed. And we're kind of getting to the end of Tefekra. We've sold the last part of our family jewels. We were only supposed to sell this part. It was only supposed to be 26 billion. It was only supposed to be sold next year, but we sold it a whole year earlier. So yes, things look fantastic this year, but that's because we had to sell the family jewels, what was left of them. So overall, yes, we are tactically overweight SA equities because of the terms of trade. We have been overweight South African bonds, but we think that's priced for perfection, and we've switched that into emerging market bonds, where we think that things are much rosier. So emerging markets are seeing inflation falling, while our inflation has been ticking up, which helps their interest rates become cut. Emerging markets have higher growth, they've got lower debt, and they've got higher AI scores. It's all looking far better from a sustainability perspective than South Africa. So we're holding on to our SA equity overweight for now, but we've reduced our SA bonds to neutral because of everything on this slide. So that brings us to positioning. So final slide before I move on to our two specific fund outlooks. So we remain overweight equities. Now, you might say why. I said earlier that volatility has been quite high. It is. We saw the Nasdaq pull back 8% when the market thought that the Fed wasn't going to cut in December. But we do think the Fed will cut, even though we think the Fed won't. Well, we think the Fed shouldn't. I think there's enough pressure, there's enough excuses with employment and political pressure to allow the Fed to cut in December. But I think come first quarter 2026, we might start to see once those inflation numbers come out. Because remember, we're not going to see any inflation numbers until after the Fed statement. So next year, once you start seeing inflation numbers come back, well, then maybe things could get a bit more wobbly. But for now, I think we'll push through to the end of the year. The markets will stay wobbly, but go higher, because we've got strong earnings growth across the world. I mean, if you look at the chart on the right, you can see there the orange line is October PMIs. The green line is Q3. So orange is October, which is first month of Q4. Green is Q3. Dark blue is Q2, and light blue is Q1. So you can see the consistent upgrade in the PMIs and the growth recovery as we've moved away from the Liberation Day in April and that fall. It's also interesting to see how the US has got the highest level of growth compared to every other region. And Europe is the only region that's seen a fall in Q4 compared to Q3, which ties up with the last chart I showed there, where US earnings and US growth continues to outperform EU quite strongly. So we've got strong earnings growth, we've got rate cuts, we've got AI momentum, we've got the EU, which is going to be doing a lot in terms of the defense spending, even if it takes some time to get there. The US households, while employment is weak, they've had $12 trillion added to their balance sheets. That's household balance sheets over the last year. That will certainly help keep the consumer spending, even as employment remains weak and some policy uncertainty is there. So we think there's enough support for equities. We remain overweight the EMs because we do think that the dollar faces a more balanced outlook. On the one hand, stronger growth in the US, stronger earnings in the US, the end of the shutdown in the US, lower interest rate differentials, all should lead to a stronger dollar. On the other hand, we've got a strong China, and we're probably likely to see the Fed cutting a bit more than they should because of political pressure, which will keep the dollar probably flat, which should be good for EMs and also driven by China's domestic policy support. And as I mentioned, all EMs besides South Africa are seeing continued falling inflation, which allows more rate cuts, which allows interest rate expenses to fall, which is good for earnings and good for consumers and good for everybody. Now, I did say that volatility is likely to stay higher, and that's evident if we look at a basket of high-risk stocks. So whether it's Bitcoin or the ARK Innovation Fund, or in particular one I like is the Goldman Sachs non-profitable tech index. It's basically people just betting on new technologies. So this is very long duration because these companies aren't going to be earning money for the next 5 or maybe even 10 years. So they're very sensitive to interest rates. And when we moved into the whole new Fed cutting cycle, the Goldman Sachs non-profitable tech index has rallied 3 times, 300% from its April lows. It just shows the huge positive sentiment towards these long duration stocks. But all of these that I've mentioned peaked in October, and they haven't recovered to their new highs. So markets are definitely becoming more discerning. They're definitely becoming more defensive. We're definitely getting closer to the end of the Fed rate cut cycle. Maybe it's not December. Maybe it's January's the last cut for the year. We're not quite sure exactly when, but we're definitely getting close to the point, which means close to the point where the bull market will end, close to the point where the dollar will strengthen, close to the point where the rally could start to fade. AI in particular has some risks. They could see disappointing capex plans just because there's such huge amounts of capex that are planned to spend over the next year. They could see a lack of monetization of AI programs. It's not just that, but they could see bottlenecks in AI because of the lack of power. Electricity prices in the US have quadrupled over the last few years because of crypto mining first, and now the AI training, which is leading to huge amounts of power required for these data centers. And China in particular has got a very strong advantage because their energy prices are half the price of the US in various regions, which means that their training is a lot cheaper, which means their AI models are more competitive. So that's also another reason why we like China. And then AI, as I said, could lead to some employment shortfalls in the short term. So a lot of risks due to AI, a lot of geopolitical risks. We've got the US's peace plan for the Ukraine and Russia, which requires the Ukraine to give up a lot of ground. So whether that happens or not is uncertain. Plus, we've now got China and Japan escalating over Taiwan. So that leads to some instability. Now, generally, when those risks stay high, gold stays high. So gold could face some tailwinds, some headwinds from the opposite. If geopolitical risks actually subside, well, that's negative for gold. Plus, a stable dollar could be negative for gold. Slowing growth in India, and India's growth is definitely slowing. India's a big driver of jewelry demand, so that could lead to slower gold retail demand. And similarly, China has recently added VAT to their retail jewelry gold demand, gold pricing, and that could lead to a slowdown in Chinese gold purchases. So we could see some headwinds to gold, which could again, be some headwinds to South African equities. But overall, as I said before, bubbles don't end when fundamentals are favorable. They end when interest rates rise. So it's all about what's going to happen. We don't have any inflation data from the US until mid-December, but next year I think it's going to work this way. In the beginning, we've got some, as we've seen for the past while, we've got inflation that's been in check. Not only has inflation been in check, but productivity has been very strong in the US, and that's kept unit labor costs close to 2%. So even though the Fed's inflation target Fed's inflation measure of core PCE is at 3%, much higher than its target of 2%, productivity has kept unit labor costs in check. But we could see that rolling maybe in Q1 of 2026, maybe sooner, maybe later, as tariff and immigration policy rises in the US, and that pushes inflation higher, and maybe productivity slows for a bit, and that could then force the Fed to unwind or stop cutting, even if there's, Kevin Hassett wants to cut, and that could lead to some volatility. So we'll be watching the US inflation numbers very closely when they finally come back. And then finally, as I said, we're neutral SA bonds because they're priced to perfection. We're overweight EM bonds. We're overweight emerging market equities. We're overweight SA equities. We're overweight equities in general. But we're very concerned that we're getting closer and closer to a peak, We might have even seen a peak, but we're not selling down yet. We're watching those until we get a stronger signal to switch out of those risk markets. So for now, the position doesn't change. We're still positioned for a strong 2026 in terms of equity markets, but we do think that the risks are the highest they've been over the last 12 months. Not that we're the closest to the recession, but we're the closest to the point where inflation could see the Fed remove the punch bowl, the Fed put disappears, and that 8% fall in the NASDAQ we saw this month could happen again in the next 3 to 6 months if inflation does come through. Okay, 3 last things before I finish off. The first is I promised to share our favorite SA equity managers. So in our signature range, we have outsourced some of our SA equities to active managers. 361, Laurium, Coronation, and Visio. We have that's on the life side. On the unit trust side, we've got the inflation plus range, CPI plus 6, CPI plus 4, CPI plus 2, and similarly we've outsourced a portion of our SA equities to active managers. We don't believe in active equity managers globally because we think those markets are very efficient. But in South Africa, we do think that there is room to outperform at various times. Sometimes underperform, but there are cycles, and that's how we do like these managers. So just interesting to compare what those managers are looking at the moment. So light blue is financials, dark blue is industrials, and almost black is resources. So starting with 361, you can see they like the banks, Absa and Standard Bank, they're the largest 2 overweight. So this is what they're holding minus the benchmark weight. So it's their biggest, highest conviction positions relative to benchmark. So they like banks, Absa and Standard Bank. They like Glencore in 3rd place, and Glencore is very much a copper play as opposed to platinum or iron ore or gold. Then Grindrod in 4th place, which is pretty much industrials. And platinum, Valterra Platinum in 5th place. So copper and platinum, 1 industrial and 2 financial stocks. Moving down to Laurium on the bottom left, they also like banks, Absa in 1st place and FirstRand in 5th place. The only resource company they have is gold. It's a bit more defensive. And then 2 industrials, but now the global industrials. So we're looking at Prosus, which is, owns Tencent. It's the Naspers sister company, and Anheuser-Busch, which is like your global alcoholic beverages company. So again, a bit more defensive, but more globally positioned, maybe for a weaker rand. Coro also liking some of the rand hedges with Quilter in number 1 place, and Northern Platinum. So they've got some platinums in 2nd place. Prosus, which again is your Tencent, so that's offshore industrials. Or Chinese tech, really. And then Dis-Chem in 4th place and Avatec in 5th place. So 2 smaller cap companies there, making up industrial companies, making up 4th and 5th. And then finally, Visio also likes Naspers and Prosus. The only financial company they have is Momentum, so more of referring insurers, but that's very much, they don't like SA insurance as such. They just think that Momentum's got some very specific growth drivers that they are excited about, not least of which is their exposure to India and the EM exposure you get through buying Momentum. And then they like both platinum and gold. So some very diversified views across our SA equity managers, which is nice to see. Okay, 2 more slides. Firstly, the Sygnia Dollar Plus Fund. So I mentioned that things could be getting a bit bumpy in the next 3 to 6 months. And if that's due to high inflation or a stagflation environment where growth is slowing and inflation is picking up, which is, I think, probably the next step after where we are right now, which is kind of Goldilocks, well, then the best place to be is in dollar cash. Now, some of you say, well, we like stablecoins, and stablecoins are a way to get dollar exposure on the crypto networks, which is great, except most stablecoins, unless there's some significant credit risk, don't give you any interest. Now, the Sygnia Dollar Plus Fund is definitely not crypto. It's just giving you dollar yield. We invest in traditional instruments. So it's giving you a dollar yield. So it's invested in dollar cash. Plus with portable alpha, it's giving you a bit of credit alpha from SA Credit. And that has resulted in the last 10 months since the fund has been launched, an annualized return of 5.5%. Now, that's just an awesome return. Now, yes, the Fed has cut rates twice over the last year. So going forward, that is likely to come down somewhere between 4.5% to 5%, depending on how much the Fed cuts. But the rand is depreciated by 5% a year against the dollar over the last 20 years. So if the rand does over the next 20 years what it's done over the last 20 years, you've got 5% in the bag from rand weakness. And then you've got nearly 5% from your yield. So you're getting almost 10% in a risk-free asset, which certainly sounds like a good place to hide from stagflation if you're worried about a slowdown. Now, SA cash is also great, and SA enhanced income is great, but then you might not see or benefit from the rand weakening if you're in those local funds. And then finally, the Sygnia Transnational Equities Fund. So I think that the chart on the bottom is fascinating. Alan Gray had a similar chart, and we've added the Transnational Fund into it because when the JSE organized what they called index harmonization, there was a big change to it, the way the indexes were calculated. So there used to be a Swiss index and an all-share index. Now the Swiss index downweighted all your multinational companies. So Richemont, Anglo-American, Billiton, Anheuser-Busch, all your big companies were downweighted because they only looked at the shares that were on the JSE. So any shares of those huge companies that were on offshore exchanges, they excluded. Then about 2 years ago, what they said is we really like this. We don't like having two indices. So they changed the all share, which had big exposure and actually had performed better. They changed the all share to the Swix methodology. So the ALSI was now the Swix, but still called the ALSI. And then they've shut down the Swix. So the ALSI has become the Swix with a smaller exposure to multinational, but it's called the ALSI. So what this chart shows is 3 sectors: banks, gold miners, and multinationals. The first bar shows the all-share index with exposure in 2015. So it's a decade ago. The middle bar shows what the all-share gives you today. And then the right-hand bar shows what our Transnational Fund gives. Now, the Transnational Fund is a passive fund in terms of we don't go over or underweight stocks. We have a systematic process that we follow. What we do is we screen all of the companies on the JSE for liquidity. After the liquidity screen, we then rank them by percentage of revenue which comes from global sources. And then we take the funds with global exposure, which is higher than 70%. And roughly right now, the Transnational Fund, even though it's JSE listed, the offshore revenue makes up about 95% of that fund. So it's very much exposed to offshore revenue, which means that if SA growth is slow, those companies still grow because the revenue is from foreign sources. Now, it all depends on what I spoke about earlier. Is SA going to have a V, U, or L shape? If you think SA is going to have a V or a U, L shape, a V shape or a U shape, then stick to the all share because that's giving you, if you look, you can see here today, the all share is giving you a very high, nearly 20% exposure to bank stocks. And that's very much, so that's banks are SA Inc. And if SA Inc. is doing well and our growth recovers, the banks are going to do really well. So if you like SA, if you think SA's growth is going to recover, the all share is the place to be because the bank stocks are going to do very well. Likewise, if you think that, so you move to the middle chart, this shows gold miners. You can see that a decade ago, the ALSI had about 1% exposure to gold shares. Now it's got close to 16%. And I think that's even higher today. And the Transnational Fund has still got some gold, but more balanced. It's got a 6% exposure to gold shares. So if you like gold, you like banks, then definitely you stay invested in the all-share index. And you can do it through our passive all-share trackers or any active manager in South Africa who are benchmark cognizant. But if you like multinationals, if you like global exposure, if you think the rest of the world's going to go faster than South Africa, then look at the right-hand chart, which shows exposure to multinationals. Now, a decade ago, the all-share had huge exposure to multinationals like Mondi, Raynet, Aspen, AB InBev, British American Tobacco, Richemont. Today, all those global companies have been downweighted by the Swix local shareholding concept. They make up 6-7% of the index. You're getting almost no global industrial exposure today from the SA equities. whereas the Transnational Fund is giving you, 35% exposure. In fact, it's even better than a decade ago, according to the All Share. So this fund is great if you're looking to diversify away from banks and gold miners, or great if you think that global companies are going to grow faster than SA companies, but your money is stuck in South Africa. If you prefer global, obviously your best thing to do is just take your money, sell South Africa, and buy global. So that's your best bet. But if your money's stuck in South Africa in an RA, retirement annuity, or living annuity, then this fund is for you. Now, just going back to the chart on the left, banks, you can see that Transnational has no banks. The fund has very little financials because it is structured to keep resources neutral so that we don't end up, but within resources, you can see there are big exposures to the Anglo-American and the BH Peterson, the big global resource companies. But because industrials and financials are allowed to change, at the moment we don't have any banks because we prefer multinationals. So resource risk is kept set at zero. And then the other thing that's great about this fund is there's a 0% management fee class. So if you really are looking for the ultimate passive product or low-cost product, systematic product, you can invest in the 0% management fee class, and then you only pay a performance fee, which is 20%, if the Transnational Fund beats the All Share Index. So it's a nice way that Sygnia is putting its money where its mouth is in terms of this particular fund. Obviously, the Transnational Fund has underperformed the top 40, as I showed in the second slide, because gold has done so well and platinum has done so well. But if you think that either gold is peaking or growth is going to be low in South Africa, it's a great place to be. And that is it from me. Let's move on to our final Q&A session for the year. Okay. Andre says, I would like to use the opportunity to extend my thanks and appreciation. Only a pleasure, Andre. I hope you have a good rest and good 2026 as well. Carl says, Sean says, Carl, stop paying lip service to SA government. They showed no intention to negotiate GOA and negotiate tariffs imposed by the USA, which is the highest level globally. They're only concerned about ASC demands. They're not concerned about SA citizens and SA living conditions. Yeah, and I suppose that's what I'm saying indirectly, that if you look at what's the results, those are the results, and that's why I don't think we're going to see growth in a V shape, because you do need not only the private sector, but you need the government to allow the private sector to come through and help. And that's what I'm struggling to see. Yes, National Treasury is trying to make every possible framework and platform in place to allow everyone to work together and things to improve, but it needs buy-in, and that is harder to achieve. So we'll see. Anonymous says Jafekra the ANC is hastily selling the last of its SA coffers with 2026 upcoming national vote and visibility of ANC's incompetence. I'd certainly say that there's a risk. We do have local elections next year. I don't think anyone's focusing on that right now. It's definitely not why we went neutral on SA bonds, but we haven't really seen too much jostling just yet from the political side, but we could, coming up to the first quarter of 2026, see some more political noise ahead of ANC government local elections, and maybe that gives foreigners foreigners cause for concern. Maybe it's good news, but maybe not, but it's definitely local elections are a risk that hasn't been priced into the market yet. So we'll have to wait and see what happens there. Anonymous says, asset allocation positioning for soon to retire retirees needing 5% drawdown and global purchasing power, considering unprecedented highs of equities in local and global returns. Anonymous, when it comes to asking for an asset allocation, it comes down to a number of things that unfortunately I can't answer on this. The one is your risk appetite. The other one is your funding levels, which then both impact your time horizon. And really it comes down to time horizon, because the longer your time frame, the more equities you can achieve in the portfolio. So that all depends on those two factors. And difficult to achieve. But possibly you want to diversify your portfolio, include the Sygnia Dollar Plus Fund, where you could get some protection against a slowed down environment and decent yield. Peter says, how come Naspers and Prosus don't make up part of the multinationals? They definitely do. They should be in that slide. Peter, I apologize if they weren't on the indices, but they definitely should be there. They are our combined our biggest industrial multinational companies. Dino says, please check facts on GN on graph 29. We not kicked out, not a US decision. We an original founder and up to, I presume you're talking about a Goa. I don't know all the details. I just know the US is threatening to kick us out, just like they've threatened to kick us out of the G20. Whether they can actually do that or not, I have no idea. But it just certainly shows that we are the least popular out of AGOA members and G20 members. Martin says, what is your view on the UK FTSE 100? That is an interesting question. I'm very bearish on the UK. The budget that came out was, again, horrendous. Much higher taxes. Yes, they need to have higher taxes like France, like South Africa, to cover the high social welfare spend and the high pension spend. But high taxes are not good for growth. But that's balanced with the fact that the FTSE 100 actually is quite a global index with quite a big exposure to energy. So if you do think that OPEC supply cuts are coming close to an end, and if you think growth is going to recover and that could push up the oil price, well, then the UK FTSE could be a nice defensive play or a nice value play to get involved. But it all depends. It depends a lot on the oil price and the large energy exposure that the UK has. I am less bearish in the market on oil, but I also can't see a big recovery in the short term. We'll have to see how that plays out next year. Right now, there's still OPEC excess supply, so there's no need to get too bearish about oil just yet. Liam says, hi, Carl, going into 2026, which local sectors would you say look most promising? Liam, we don't take views on SA sectors, and it all depends on what local companies you like. If I look at our 4 SA equity managers, it was interesting to see that 3 of the 4 are underweight gold. And the 4th has got a very small overweight to gold, and 2, Coronation and 361, have got massive underweights to gold. So if they are right, then resources could certainly the active managers are waiting for resources to pull back next year, driven by gold and platinum, and that could see financials or industrials recovering. Also, 2 of those managers are very excited. In fact, their biggest overweights are in SA banks, because there's been quite a dislocation between bank PEs and bond yields. So normally as bond yields rise, so bank PEs fall, and as bond yields fall, as they have, bank PEs normally rise. And there's been a bit of a dislocation over the last 6 months where our bond yields have fallen as foreigners have got involved, but our bank PEs haven't rallied. So a lot of the active managers, or definitely 2 of the active managers, their biggest positions are over at SA banks. So I would say, just high level, looking at what our active managers are doing, they don't like gold, they do like banks from a sector exposure. Anonymous says, is the SA equity component in the skeleton range still capped SWIX, or is it the Transnational fund? Good question. SA equity within our balance funds is capped SWIX. We don't have transnational exposure to those funds. We prefer just going directly into global equities. And we are over global equities compared to many of our peers. And Paul says, you mentioned that we have a brilliant fund minister. I doubt that's correct. Okay. It's certainly your view. John says, hi, Carl, thanks again for really interesting analysis and presentation. Re-EMs, these are usually cyclical, but is your assessment of China a more longer-term EM bet? That's 2 good points, John. So certainly EMs are very cyclical. and very much dependent on a weak dollar and rest of world growth outperforming the US growth. So they kind of depend in the short term of you can't have US exceptionalism and EM strength at the same time. That said, China is looking far more investable, and they're doing all the right things in terms of R&D spend. They were the highest on the chart I mentioned earlier in terms of GDP to R&D over GDP, so much higher than the US, and very high in the AI. They've got low energy costs. So while China doesn't have the same private property rights as the US, they're certainly doing everything to look more investable. But right now, we don't believe that you can strategically avoid emerging markets yet. We don't have emerging markets as a building block in our strategic asset allocation. We are tactically avoid EMs, but we still think that AI in particular will be better for developed markets than EMs. And yeah, we definitely have a cyclical overweight to EMs, not a structural overweight. Donovan says, what is the best fund to get exposure to emerging markets? Donovan, that would be the Sygnia Dollar Emerging Market 50 ETF. That's pure emerging market exposure. Sean says, great insights. Thank you. Only a pleasure. Thank you, Sean. We'll see you next year, 2026. Pleasure, Troy. Johan Kruger says, the US AI spend is immediate revenue on the income side, but depreciated over several years. That spells relatively lower earnings over the coming years. You're spot on. That's exactly what I was saying, that not only are we seeing higher capex, but the depreciation has moved from 3 years to 6 years, which means that we've got higher depreciation coming from current years, plus the catch-up as that depreciation from 5 years ago catches up to us. That leads to relatively lower earnings, correct? Surely that means US earnings will disappoint from next year. It does not look as if the other 493 companies can make up for Mag 7 are lagging. That's definitely a good point. We are seeing an acceleration in the S&P 493s, the non-Mag 7, but the US will be less exceptional as Mag 7 slows. But if you compare it to Europe, where earnings grew minus 3%, you don't really have to grow that much to beat the rest of the world. So that would still make them quite attractive. Now, you might say Japan's looking quite excited, particularly because the new Prime Minister is doing a whole new ABE inflationary focus. So maybe Japan is the place to be. We still stay neutral. So we haven't actually gone overweight US or Japan. We're probably most bearish on Europe. But you're right. As the US slows, the question is to what extent does the rotation take over? Or does the US just slow as a whole? I still like the fact that the US has got the highest AI adoption in the world. And it's not just in the large companies, but medium cap and small cap companies in the US are adopting AI. So we're likely to see productivity improve quite quickly in US companies across the 493 as they adopt AI, which should improve margins and earnings, even if it is at the expense of employment. So I do think that we could see further acceleration in the 493. But I hear your point with it. Whether it replaces the entire AI spend is not known. I suppose the other point is that AI spend is not disappearing. On AI earnings are not disappearing. They're just slowing. Anonymous says, what about rates? It's a good question. That all depends on your outlook for interest rates. If you think interest rates are going to fall significantly as the Fed cuts, or then global property could recover, particularly those sectors focused on data warehouses and storage and other more structural, non-retail focused funds. But if you think that you're going to see sticky inflation like I do, and the Fed can't cut as much as they want to, well, then you don't really want to get involved in the property sector. Mr. Naka says, how do we fix incompetence and efficiency problems in all spheres of government? Government cannot be such a large part of the economy, about 20% of GDP, riddled with incompetence and inefficiency, and still expect long-term sustainable growth. I suppose that's exactly what I'm saying. The best way to fix it is private-public partnerships. Certainly, National Treasury seem to be aware of that, but it's getting that private sector to work with the government sector to get things going forward. And I am hopeful but I do think it'll take longer than expected. But to answer your question, yeah, I don't know how you fix those things. That is beyond me. Johan Muller says, what fund has the greatest exposure to gold? So that would be our top 40, our passive top 40 fund that has the underlying ALSI exposure. And I think the 36% that I mentioned before, that was MSCI South Africa. But the top 40 South Africa has about 27% exposure to platinum and gold. So that's quite high. So you just go for top 40 SA and you get 27% precious metal exposure. If you want more multinationals, you go into Transnational. David, thank you, Carl. Pleasure, David. High AI spending must correlate with monetization for confidence in FANG to increase. Correct. A lot of capex laid out so far, but no immediate plans for profits. For example, OpenAI. David, it's exactly what I'm saying. Particularly last month, I said that when you had Sam Altman saying that profitability is not in his top 10 concerns. So, how long do you think before AI's profitability increases? Well, that's a great question. So, yeah, it needs to happen quite soon if you want to get confidence to come back. I suppose right now, share prices are reacting not to profitability, but to how clever your AI model is. And we saw that happen with Google when their Gemini 3.0 came out and Google's share price shot out the lights. I suppose the better the model, the higher the probability of monetizing that model. So the market hasn't quite got there yet, or I suppose we're maybe rotating towards the point of worrying about or seeing actual monetization. They're still happy to see it in the future. But yeah, I don't know how forgiving the market's going to be. I think that's also going to be linked to Fed interest rates, and how supportive the Fed is to the overall market. So yeah, the party could end soon if people give up waiting for AI monetization. But if maybe they get excited about new models, and the excitement of new models means that it extends their time frame. But of course, you could see another DeepSeek, and you get an even better model coming out of China for half the price or quarter of the price, and then monetization becomes a big issue in the short term, as we saw when DeepSeek AI came out, nearly a year ago, I think, and derailed those stocks. Barry says, hi, Carl, please chat through the changes in foreign exposures to ALSI as a result of the changes. Yeah, Barry, just to repeat, I mean, the presentation will be on our YouTube site, and you can then look at the chart in more details. But we used to have two indices, SWIX and the All Share. The SWIX stood for the shareholder weighted index. And basically, it didn't take the market cap of a company, it took the market cap on the JSE of a company. So, Anglo American has shares on the FTSE 100, and so those shares get removed from the market cap, and that then downweights those companies. So the way that our all share now is calculated is any companies that have another listing, those shares are removed from the weighting, and so that upweights all the local stocks, and that has then upweighted banks, and it's upweighted gold shares quite a lot. Sean has a comment. US doesn't have to kick SA out of G20, just not issue visas to SA government attendees, as it will be in Miami. So by default, it is what it is. That's a good point, Sean. In reality, SA should not qualify due to the size of the economy. I hadn't actually looked at those numbers, but it's a good point, Sean. Anonymous says, is China not considered a developed market? No. So China's 15th five-year plan came out in the last month, and they want to be a developed market by 2030. So you need developed market status is based on GDP per capita. China still has a long way to go to achieve the GDP capita of developed markets, but they're planning on growing the GDP per capita, and that's all through social welfare spend, or at least creating social welfare networks so that consumers will spend more and domestic demand will drive growth, and domestic or the consumers will become wealthier, GDP per capita. And as that happens, so that wealth of the average Chinese consumer will grow, and then if they reach the level of a developed market, then they can be included as a DM. But right now, they are not a DM. Johan says, which proportion of SA's exports is affected by higher tariffs? Our minerals are excluded. It does seem food and car exports are worse affected. You're spot on. It is food, particularly citrus, and car exports are definitely worst affected. Some countries have massive tariffs on imports, much higher than Trump's tariffs, e.g., Japanese rice imports. Why are countries so negative on trade with the US when their tariffs aren't particularly high versus many countries? Is it the media or perhaps just an expectation gap? They never expected the US to raise tariffs. Johan, I think you're spot on. I think it's just a change. There's people don't even know what the status quo is. It's just the status quo. They don't know if they're high. So just as like South Africa has very high imports on many products, which might mean that we should have a 30% tariff. I'm not exactly sure. I haven't seen those workings, but yeah, it's just change. And everything in markets are relatively efficient. They price in the current status quo, and any change to that status quo changes market pricing, and you see relative moves. Donovan says, thanks, pleasure, Donovan. Mandy says, thanks, pleasure, Mandy. You have made me slimmer. I'm not quite sure what that means. Oh, slimmer. Okay, sorry. My Afrikaans is not great, Mandy, but great. That's great. Thank you. Have a lovely December. Pleasure. So I'm just going to scroll through these, but everyone says thank you and pleasure. And I hope all of you also have a wonderful holiday and a wonderful 2026. Sorry, a quick question here on local construction essay. Yeah, I haven't seen anything about local construction. It's become such a small part of the South African listed universe that fund managers really speak about it. And I know there's big issues with construction mafia. So I suppose it's very tied to South African growth. It's very tied to fixed developed investment, which you're not seeing. I suppose if the private-public partnerships get off the ground, construction could improve. But you have to wait to see those actually happening. Dino says, can the huge crypto correction add to systemic risk for equities? Definitely. And as I mentioned in the outlook, crypto is definitely seen as one of the longer duration asset classes. And it can be, some people say it's a canary in the coal mine and they're expecting equities to fall because crypto has fallen. I don't think there's the same, it's not as easily to confirm causality, but it is definitely a factor to consider. Dion says the US adoption rate for AI is highest. How China's filling patents 9 times higher. Agreed. China probably could catch up to the US in terms of AI adoption quite soon. But as I said, they do adjust it for your services sector versus your manufacturing sector because AI is easiest to adopt in services. Sean says, if US Treasury drops rates again versus rising Japanese rates, is this not going to suck liquidity and USD demand out and further exacerbate? Yeah, so Sean, I hear your point. So Japan is seen as one of the funders of the carry trade. People borrow in yen because interest rates are so low, and then they invest in emerging markets, and you get a nice differential. What could happen if the US cut rates and Japan raises rates, you could see the carry trade just switch from yen funding into dollar funding. I don't think it's going to be the end of the carry trade. Or if not, it could switch from yen funding into maybe Chinese funding because Chinese interest rates are the lowest in decades, or even European funding. So I don't see that as a huge risk. Definitely some volatility, but not a huge risk. Pleasure. And last question from George is, what about SA property? So again, we are tactically overweight SA property, and that's worked very nicely over the last month or two. But structurally, we haven't got property as one of our strategic asset allocation classes. A, it's too small. It's just 4% of the all share. And B, we definitely think there are still some supply-demand dynamics that need to work out in terms of excess office supply, excess what are those things called? Shopping centers, and that also has to work out. Plus, very unfortunate cost increases to landlords because of the cost of water and cost of power going up, and obviously they're having to finance a lot of solar panels, or at least give some rebates to their tenants who have to then cover that cost. So, tactically overweight, but not strategically overweight property. And that is it. Thank you, everybody. We're just out of time. I hope you have a wonderful festive season. Happy holidays, happy school holidays, happy religious holidays, happy work holidays, happy just holidays. I hope you have a wonderful break. And I'll see you all in 2026. Our next webinar will be on Tuesday, the 3rd of February. Nothing in Jan, so I'll see you early Feb. Have a wonderful break.